Welcome everyone to this Friday webinar. We had done webinar once with Samit, I remember, in 2022 and 23 also. In 2024, this is our first webinar with Samit. Thank you so much, Samit, for giving us time. And there could not be a better time than now because all of us, I think, were awaiting this time for market to correct over time. Investors have become evolved, advisors have become evolved, and we were like no more, new to seeing correction. Like correction now is like most welcome because you are all waiting for it. And I do not know how deep this correction will go. I don't think anybody would know that. The topic of this discussion is not particularly on what's the view ahead in near term, and we are not going to discuss any stocks. But in overall, in long-term context, there have been certain things that I have seen have evolved within SageOne because we closely watch each and every fund manager, each and every portfolio, and I see your core portfolio has done very well. Your small cap portfolio has done on an average. At the same time, you have delivered returns without participating in some of the momentum side of the market like PSUs where others have participated. You have not. You have kind of remained where you were. But at the same time, you also have had your I would say a few quarters of learnings which happened last year, and then after that there was no looking back. So we want to know all that because your learnings, I would say, dissemination in terms of knowledge through this webinar is the ultimate aim. And we regard you as one of the alpha focused fund managers, and that is exactly what we chase amongst the entire space of alternatives. So welcome formally to this webinar, and maybe your opening remarks on where do you see markets are in terms of valuations, in terms of overall scenario where we are, and then from there onwards we'll kind of take this conversation ahead.
Yes. No, thank you so much, Kamal. And thank you participants for joining. I'm looking forward to this interaction. Any question that you may have, I would be glad to answer. And it's been a long time, so it's even more exciting. See, to start with, I would say that I think in the last maybe few quarters or maybe last 1.5 years, the main topic of discussions with most investors have been, is this right time? Is it overvalued? And, is it time to get out, book profits? And once you go through multiple cycles, it becomes even more and more clear to you how difficult it is to, time the market. Every time markets teach you different lessons, and what you think may happen really never happens. Just example of COVID, post-COVID, there is absolutely no question in everyone's mind that the economy is going to go through one of the worst phases that the world has ever seen. And the markets never really look back after bottoming in March 2020. After that, it just went one way up and the economy kept going one way down. So markets can have such a huge variance in terms of direction that it's very difficult to predict. You can never just look at sort of economy and where it's headed and think that even markets are going to go in the same direction. There are so many factors like liquidity. There are factors of, government pumping in money, the Fed pumping in money, and so a lot of variables are completely different each time. We had never seen that kind of liquidity, and now we are going through one of the longest bull market for India, right? So most of the investors haven't experienced that. Some of the investors have experienced the 2003 to 2008 kind of a bull market, but that was a global bull market. Everyone had participated at that time. There was global liquidity. There was global bullishness. China was spending money like anything, on infrastructure, and it was the fastest growth phase for China. And it was helping a lot of other economies. Now you are in a phase where China is actually going the other way. It's slowing down. Europe is not in such a great shape. US is doing well, but still, nothing extraordinary. And India is in a phase where I think it's standing out compared to anyone else. And that's where India has done so well. And now question is, do you just look at previous cycles and think, okay, India has reached certain P multiple, and do you just get out? there are so many different variables even now compared to the previous cycles. India has never seen such low leverage on the balance sheet. 0.2 times, less than 0.2 times of debt to equity, median debt to equity for the top 1,000 companies. And then you are seeing that the working capital cycle has shrunk. Companies are generating much higher return on equity, especially small cap, mid caps too, are generating, compared to 12-13% return on equity, generating 15-16% of return on equity, and still have very little debt on the balance sheet. And some of the companies have expanded, they have multiplied their sort of assets by 2 or 3 times in the last 4 or 5 years. And at the same time, they have deleveraged, they have paid off all their debt, which such cycles we have never really seen. And it's possible that these kind of cycles, may last for much longer than what people believe. Right. So, and that's been the tricky part about this cycle, that the valuations have reached highs and then the fundamentals have kept on improving. And we don't know how long will this last. And the stock market keeps on going up, mainly because the fundamentals keep on surprising. I mean, growth is something which has picked up. I mean, it disappointed from 2012, 2000 and maybe 2021. But post that, last 3 years have been pretty significant growth without taking leverage. Right. So a lot of variable parts, even for, experienced investors, this kind of cycle is a completely new learning. You can't really see any sort of replication of this kind of cycle before. Right. So even we have gone through learnings, and we have not tried to go against the market. We are okay. Timing is always difficult, and it's tricky to take a timing call, as we have seen, multiple times in the past. And then how to ride through the cycle, we will maybe, talk much in depth, as we go ahead. But I'll stop with those, that kind of opening remark.
Sure, Samit. So, I move on to my, first question, which I often kind of have to face with my clients, with markets kind of getting into new territory, as you are mentioning. What is a relevant measure to understand, market valuations? Is PE or price to book a relevant measure anymore? What are the yardsticks mathematically or statistically if one has to actually define one's portfolio's risk?
Right.
What should one focus upon?
Right. See, now I think what happens is that there is no real benchmark for metrics. So PE multiple, price to book, EV by EBITDA. Sometimes you can look at, your replacement value, depending on the industries. In real estate, you can look at sort of what are the, what is the development potential from the land bank. There are a lot of metrics. Even sometimes oil companies can be measured with respect to what kind of reserves they have. Even cement companies can be measured. We're looking at what kind of limestone reserves they have. Right? So there are various metrics, but generally broadly followed metrics are price to earnings, EV by EBITDA, price to book, those kind of metrics. Those are at a market level. Those do make sense, because some sectors may be overvalued, undervalued, but on an average, PE multiple is reasonable. But I think one also have to look at the balance sheet side. None of these. So price to book at least has, the balance sheet reflected in it, but P multiple does not have a balance sheet, right? So for example, if you, even within same industry, right, two companies trade at such a divergent valuations, and why? So for me, two of the biggest, I would say, parameters which drive the valuation. One is the duration of growth. Okay, if an economy is going to grow at say 7-8% for 5 years, versus an economy can grow at 5-8% up to 20 years or 30 years, those two economies will be valued completely differently. Similar to how companies do get valued, duration is one of the biggest driver of growth, right? And you would see that the reason consistently growth companies like HUL or these kind of companies do get much higher multiple than very cyclical companies, because they know that this duration of growth is much higher, even though the quantum of growth may be lower. It can be just 10, 11%, but everyone knows that even 30 years down the line, 40 years down the line, these companies are probably going to grow at a similar rate and would also survive, right? Whereas companies where you can't predict, like steel companies or a lot of commodity companies, they depend a lot on the global commodity cycle, and there are a lot of factors which are unpredictable. What China will do or what will happen in the globe. If there is some attack on some certain country and if some resources get blocked, and that prices can go up. There are a lot of uncertainty, and hence figuring out duration sometimes it's very difficult, because investors' horizon, even if may not be 30, but in their horizon of say 3, 4, 5 years, if there is one cycle where the earnings are going to drop like a stone, no one wants to take that risk, because you don't know when that will happen. And because of that risk, the P multiples are always low, because by investing in such companies, investors expect to make much higher returns than by investing in companies like say HUL or Asian Paints or much consistently growing companies. So as soon as your expected rate of return goes up, that means you're discounting it at much higher rate than by discounting at lower rate for the very safe companies. And I had shown Excel showing that if a same cash flow you discount it by 12%, for one company you'll get a P multiple of 60 times. For other company, if your expected rate of return is say 18% compared to 12%, if you discount the same cash flow by 18%, your P multiple drops to 10 times. So there's a huge gap of 60 and 10 just because of the discounting. Now coming back to India, now because of the balance sheet and because of the policies, because of the infrastructure development, I think there is an argument you can make that the duration of growth of India has definitely extended, and there is less chance of a shock that can come up, unless the government changes to disrupt this kind of a growth. So growth may slow down from say 7.5% to maybe 6.5 or 7, but no one is expecting this growth to slow down to like 3, 4, 5%, what the most countries grow at. So one is the duration of growth. Also, the risk associated with India has gone down. So meaning that if the balance sheet of India, corporate India is strong, the balance sheet of government is strong, the forex reserves are strong, the inflation is so much in control, right? And even fiscal deficits are reducing every quarter. Definitely the risk associated with corporate India has gone down, and hence compared to its history, maybe corporate India deserves a better multiple, just as any company gets. As company seems safer, you get give a better multiple. As company's balance sheet improves, it becomes debt free, ROE, ROC improves, you give better multiple. So you have to look at the fundamentals, the balance sheet, and sort of the duration of that growth to give it a multiple, which is a very tricky business. But one thing can be sure, that compared to the historical average, we definitely deserve to trade at higher multiple. Now you can't just come in and paint all the companies with the same brush. There are companies who are probably doesn't have the right corporate governance, and maybe the balance sheet is not as strong. You'll have to differentiate those. But today it's very difficult to even find one company which will go bankrupt. That's how strong the balance sheets of companies are, and not just large cap companies, but across even the small micro caps. Very difficult to see any company which is going to go bankrupt, right? So it's all these factors you need to put together to apply a certain multiple, and that multiple range, as I said, for the same cash flow, depending on how much you discount it by, can have a 10 times multiple or a 60 times multiple. So it's a very tricky business. Valuation is better done at a stock level, and hence rather than looking at the market valuation, it's better to look at your own portfolio and see if you are comfortable with those, the set of companies you hold, and whether they are trading at a reasonable valuation.
Absolutely, very well said. And that is why, we generally and more specifically talk about PMS versus mutual fund also, because mutual funds are the products which kind of hug the index and they are like more mirroring the market. But PMS obviously, creates the portfolio over time, and then it's a more a company level game. Absolutely, well said.
Exactly. I mean, one of the investors asked me, he showed one of the foreign investors, because he knows what the portfolio is. And he said, your portfolio valuation in a mid cap, small cap space is, at that time, it was, 1 year photo multiple was, I think, 19 times. And there was another larger fund which had diverse, 60 stocks in the portfolio. And that multiple was 40 times. He said, why is there so much difference? I told him that if I, instead of finding 16 stocks, 17 stocks, if you tell me to find 60 stocks or 70 stocks with similar attractive valuation, I will not be able to find, because there are not so many opportunities available. So if my job is to find limited number of stocks, I can find. Even in that 60 stock portfolio of some other fund manager, there were 20 stocks which were trading at below 15 times multiple. But the average multiple was 40 times. So that's the advantage of a concentrated portfolio. Of course, it also has the other side risk, but if you are careful and if you can identify the right businesses at the right valuation, it's easier to do it by finding 15, 16 stocks rather than 60, 70 stocks.
Sure, Samit. Moving on to the subsequent, part of our discussion. I also kind of get this question from most of the investors, and it's like, again, we have seen how markets are evolving, like you have been kind of conveying that we have been learning constantly, and the kind of bull run that we have seen in the recent past was kind of never seen before, and that is why you are learning as it's kind of building. Now we have also seen markets going from value to growth to momentum, and then from momentum to quality, and then from quality it after that it corrects and again goes back to value, growth, momentum. So this old learning that we have had, are we again going to see a similar pattern whereby now markets started from value, went to growth, and then we have seen markets in momentum phase for last say 6 months, and now they're again going to say quality, or you have a different view in this regards?
No, I think, markets are always cyclical. They keep on. There is always, like in 2011 to 2020, it was completely quality kind of bull run. Even though economy wasn't growing that much, but all the quality companies, their multiple went up 3x. All these companies, I made a presentation in the CFA showing that until 2011, the P multiples of Sensex and a lot of these quality companies was almost the same for the last 10 years. Whereas from 2011 onwards, that multiples have expanded 3x for these quality companies. Right? And now post-COVID, exact opposite has happened. Is that the value stocks, which people find maybe not value stock, but lower quality business stocks like the PSU stocks or the infrastructure companies, capital goods, which are going into government related power projects. Those companies were, had not delivered much. Real estate companies had not delivered in the last 10 years. And they have more than made up for the lost returns over the last decade. Right? So in the long run, sometimes, there is very little differentiation in returns. It's just the way or the path of return is different. For the quality companies, it was that 10 years and then they probably stayed flat. And now suddenly, they have made up, and some of these companies have gone up not just 3, 4, 5x, but they have gone up by 20, 30x, right? Which made up for their lost returns for the last 2 decades, probably, or at least from 2008 onwards. And these are the cycles. It's very difficult to predict these cycles. Whether it will be, momentum or whether it will be quality. It depends a lot on, your environment too. The reason quality companies did well during 2012, 2020 was that the growth in the Indian economy and growth at corporate India level dropped to mid single digits, 5-6%. And there was very little growth available. At the same time, quality companies kept on growing at 11, 12, 13%, which was their normalized growth, even in a regular economy. And that incremental growth and the consistent growth is where all the FIIs and investors then migrated towards, because investors will migrate towards growth. So I think rather than looking at value or growth or momentum, I would say that investors will always migrate towards the earnings growth stories. Today they are migrating towards PSUs or infrastructure because that's where the growth is. When they were growing at 5%, my investor migrated towards something which was at 11-12%. Now 11-12% remains at 11-12%, but these companies which were growing at 5% have started growing at 15, 20, 30%. So investors are migrating, or in anticipation of that growth, investors are migrating towards these kind of companies. So that's where I feel that it's very difficult to time the cycle. But if you are chasing growth at reasonable value, generally you will probably migrate towards the right segments of sectors. But it has to be bottoms up. You can't just broad base and then say, okay, I'm going to put it in all the PSU stocks. There are many companies who are probably going to be exposed toward the same sectors, but which are private companies and manage much well, and where the duration of growth will be much higher. Investors generally migrate more towards like short-term sharp growth. If they see that next 1 year or next few quarters are going to be great, everyone is going to migrate towards those, and they will run up the stocks. So difficult to time, but if you just keep on chasing high growth, generally you will get most of the cycles reasonably right. You may not get it exactly right. You may not make the most of the best of the money, but you will make way better than average money. And that's what, if you keep on consistently doing it over a longer period of time, you probably will be in the top decile of the returns. It's more important that you shouldn't miss out on any of the cycle completely, but be in the top half or top 30% all the time, and you will be in the top even 5% if you remain in the top 30% all the time.
Sure, Samit, well said. Within your portfolios, I have been noticing them over the last 5-6 years. Mostly you are kind of always very, very less exposed to financial services. You're mostly exposed to B2B services or B2B companies or, manufacturing businesses, but very less in financials. But at present, we have seen, financials, as per most, I would say, estimates, are seen as relatively more attractive in comparison to other segments of the market. So has your view in your portfolio management across your portfolios also kind of leaning towards adding more financials, or your views are still the same, as your old way of managing?
Yeah. See, the reason we haven't been much into, we have been in financials, not in banks, not even in private banks, mainly because our minimum requirement of growth is 20%. And very few banks grow at that rate. Most of them have ROE of 12, 13, 14, 15, 16% in that range. And generally for banks, return on equity is the raw material for growth. And that's where their growth is generally limited by the ROE. And hence it's lower than what we look for, and hence irrespective of valuation. See, valuation is never our first, parameter to decide. It has to be growth supported by, the resilience of growth as well as certainty of growth. And then valuation comes second, So hence banks are never part of our portfolios or have not been much. But we have had NBFCs. So high growth NBFC, we held Bajaj Finance for a long period of time. In the recent times, we do have Muthoot Finance kind of companies. We had Mandapuram in the short run. We do have Chola Holdings as one of the companies. We also have insurance companies. So if they deliver 20% plus growth and are available at reasonable price, we are fine holding on to that. I think going forward, valuations may have become cheaper for financials, but remember that India's balance sheet is pretty deleveraged, and they are making reasonable amount of internal accruals, as well as the ROE has improved. So the need for leveraging or borrowing money probably has gone down. At the same time, whoever wants to expand are going for QIPs, or they're able to easily raise money from the equity market. which is much more attractive for them, and hence it's possible that there may not be that high a growth as what we have experienced in the past 2 decades. Instead of 15-16% growth, they could also grow at 11-12% nominal GDP, and which is not good enough growth, for us. And even there could be pressure on the NIMs, given that it's difficult to get fixed or savings, CASA as well as deposits, given that people are getting much better returns everywhere else. So the supply of money is not easy for banks. At the same time, the demand of borrowers is also not done, which is not a great scenario. So maybe they're good if your expected returns are in that 12-13% kind of a range. You're getting at really good value. But if your expected return is about 20%, a lot of these do not fit into that criteria.
No, absolutely. This is what kind of makes you very different fund manager. Amongst so many fund managers I have kind of discussed, generally this question gets asked, and most fund managers have been kind of maybe focusing on valuations first on relative basis, because that is what is kind of taking our attention these days. And hence they are saying financials are the first sector. But you are seeing more from the point of view of maybe potential growth, and that too not for maybe recent future, but for long term, because
Correct.
longevity of growth is also something that is important to you. And that is why your, I would say, confidence on adding something like financials, especially the banks, is relatively lower. Absolutely, this is like very brilliant and very insightful. Moving on to another sector, that I have seen in your portfolio, which you have had, over time, which is like real estate and real estate kind of businesses like building material businesses and all. So over time, we have seen after COVID, especially, some of those businesses have actually picked up. So is that theme continue to, I would say, expand in your portfolio, or you are trying to shift it and find new such theme? And if so, then which would that be new such theme?
Sure. No, I mean, real estate is something which we have liked, and especially after, it went through a almost 10-year kind of stagnation. Inventory levels in real estate had picked up, after the growth slowdown. So there was huge sort of supply, which came in after 2008, 9, 10, 11, and at the same time, the growth slowed down. So inventory levels had picked up. Today, inventory levels, even today, are at 14-year low, right? So there is supply, but it's not as easy to get supply today compared to what, used to be 10 years back, because of RERA, because of the regulations. It is difficult. Only big builders are able to get the supply. So number of builders have shrunk. Inventory level are at 14-year low, and especially, India has had a K-shaped recovery, right? So it's not that all the population is doing well, but premium, anything which is luxury premium, is doing really well. So real estate is all about, location. You can't really generalize it, but if you are in the right pocket, with the right set of customers, I think it's doing exceedingly well. It had become really cheap. So we are playing real estate through builders, with good brand, as well as building materials, wherever we find reasonable value, and where there are real building materials which are dominant. So we don't really have any cement play, but I mean, we have been holding, structural steel pipes, electrical cables, those kind of companies, because their usage is pretty diverse. It's not just dependent on real estate, which is residential. They will go for commercial. It's also utilized in infrastructure. Even if you are putting up warehouses, airports, ports, power distribution, power transmission, everywhere you would need a lot of these products. So where companies are very few, but their usage is across multiple sectors. We are betting on those. Even if valuations may have gone up, little bit above maybe what the fair value is, better to bet on these where there is spending, where the certainty of growth is much higher, and there are very few dominant players. So the increase of competition is not as easy as in many other commoditized kind of segments.
From here onwards, what are the new themes? Like at times you have had stocks like Deepak Nitrite, from specialty chemicals, Aarti Industries, and then building materials. So now from here onwards, what are those themes? The second part of the question that you want to identify.
Sure. See, I mean, we had invested in specialty chemical for a long period of time, and while exiting, probably we were a little late in exiting, and we paid the price, for that in 2023. As you said, we had a tough that 1 year, and we learn our lessons, and now but we are rebuilding our portfolio, not in the completely specialty chemical, but I think the CDMO space looks really interesting, given that there are US regulations which are banning Chinese companies. At the same time, many of the Indian CDMO players have put up big capacity. Customers will never come to you unless you really have a ready-made capacity as well as the competence to deliver. And we find few of these companies who are in that space, which looks good. We continue to like real estate. Even now, I feel there are few more years to go, given that inventory levels are still at 14-year low. It's been dropping, and the drop hasn't stopped yet. So there is room for demand. I mean, we were just looking at China's home buying is almost 13 to 14% of their GDP. India's had reached 1%. Now it's climbed to 2%. At the peak, it was still at 3-4%. But, even now, it's very small portion of our GDP compared to many developed economies. So, I think there is a lot of room. And again, building materials, because you need to follow wherever there is spending. The two big segments which are spending, one is government and another one is the prime population, the richest segment of the population. So we are following that. Government is spending on all kinds of infrastructure projects. So any building material, again, which are used in that, where main thing is the suppliers should not increase in numbers. That means they should have huge barriers to entry to get into these businesses, and the growth will be taken advantage by those few suppliers who are currently there. Otherwise, like infrastructure, you don't know, like against 10 players, there will be 100 players, in the next 2-3 years. And then the profits will be diluted. Everyone will go into losses. That's not something that you want, because it's not just important to look at the demand side, but also the supply side. I think looking at the supply side is even more important than the demand side. So we are looking at these players where the supply side is very restricted, and so looking at that same in real estate, building materials, and then also the the CDMO side is something that we like. We also like some NBFCs. So gold finance is something that we like. Home finance is something that we like. Insurance is something that we really like, and we are betting on those. So these 3 or 4 sectors are something which we are really even now extremely positive, and we are able to find reasonable value. There's nothing cheap in this market, but there is reasonable value, and who knows, we could go into a reasonable correction, and maybe some of these companies can become cheap, because in a knee-jerk reaction, like what happens after a war or such sudden development, everything corrects, and sometimes you wait for the opportunities to add up in these stocks.
Sure. Can you please explain, CDMO little more in detail by giving examples of some of the businesses?
Right. So see, CDMO, like one of the leading company in India is like Divi's Laboratories, right? So this is basically the innovator companies, who are mostly global pharma companies in nature. They want to, outsource the initial development of their molecule. So the CDMO companies, which is the contract development and manufacturing companies, these are the companies who help them develop first at a very small level, and try to figure out the most efficient way of manufacturing that molecule, and then move that into the commercial phase where they can produce and supply that over their maybe horizon. Most of the time one manufacturer succeeds, so they get paid during the development phase. But if one of the molecule really succeeds, then there is a huge supply of which they can take advantage of. And hence, as I said, CDMOs are very specialized companies who work with the innovators, and there are huge levels of skills that you need, quality that you need. You need to have the processes in place because you also need to be approved by FDA, and then also having the capacity to manufacture, because once the molecule is commercialized, the demand suddenly shoots up. Sometimes these are billions of dollars of drugs which are manufactured by during their patent phase, manufactured by one or two such CDMO plays. And that's the CDMO where China used to be the biggest manufacturer, but there are regulations which were put for bio companies where they have banned Chinese companies in supplying that, and hence there is no other country which is easily going to replace their capacity. There are Indian companies who have put up a lot of capacity. So companies like DVs, there is Laurus Lab, there is Newland Labs, and there are many smaller companies too. But these are the kind of companies who will benefit, and you see that in the last few quarters, their demand has suddenly picked up. When the overall chemical and specialty chemical hasn't really picked up, they're still going through big margin pressure. But these couple of these segments have emerged out. They're reaching the same margin level as pre-COVID, and their volume also has picked up. So always out of a big segment, if there is niche which is picking up, it's time to notice them and bet on them, because it's not going to be just 1 or 2 year cycle. It's going to be probably a decade cycle.
Understood. Out of the two products, which are like core and SSP, SageOne core PMS and SSP, core has done fairly well, but SSP, has not relatively performed as well. In fact, it has underperformed over last 1.5 2 years. Now, obviously, that underperformance on one side can be viewed as an opportunity in these times for anybody to invest into small cap space, because small cap space otherwise looks to be very expensive. Or one could say that there is definitely something which is not working, and hence maybe one should ignore that. How do you see that small cap side of your portfolio, and why has it underperformed, and what is your kind of reflection of that?
Sure. Yeah, so see, core portfolio also underperformed during that 2020 to 23 cycle for a year or so, and that was our first year of underperformance since 2012. And at that time I used to say that sometimes you do get maybe some themes wrong, or you miss out on certs. It's important that you correct them. First you need to identify whether it was a mistake, or is it just that you bet on the right companies but maybe they didn't perform during a time. It's possible. And if there is a correction that's needed, you do it and move on. And we have had underperformance even before, but this was very drastic underperformance during that time. And generally, whenever we had a slow period, the next few years are much better than average. And hence, that played out as we made the changes. We got out of some specialty chemical companies and some pharma companies where we probably extended our stay by a couple of more quarters than what we should have. And we made those corrections. And then we have had great year and a half after that. So right from the start, that SCP performance is about 29.3%. Small cap portfolio we launched in April 2019, and for the first 2 or 3 years, it was the one of the topmost performing PMSs. Where it had outperformed the small cap index by probably 15-20% at that time. But last year was last 1 year has been difficult for small cap. I don't know. I mean, there is no specific reason for it. It's just that the companies in which we have invested, they have delivered in terms of earnings growth compared to what we had expected from them. But none of them have gotten really re-rated. A lot of the growth in small cap index has been just re-rating of multiples. So if you have missed out on those, favored kind of themes, and you didn't get much in whether it's the PSU side or whether it's capital goods side. So small cap is such a large set of companies. There are 1,000 companies, out of which you pick 16, 17. It's possible that sometimes you get where you don't get any of those storied kind of sectors. And we have tried to again dig deep into why and what. Wherever we thought that there are changes needed, we have done those changes. So hopefully, see, our portfolios generally in a down cycle have created the biggest alpha. It's not in the up cycle that we have created the biggest alpha, right? So since launch in April 2019, the small cap is still up 30% per year, and compared to that, the small cap index is up probably 20% or around that. So you've still generated 10% alpha every year on an average. So hopefully, this is one-off year. I don't think we have, wherever we thought we made mistakes or where the growth is slowed down, we have gotten out of that. We have, changed the portfolio. And now the portfolio that we are pretty confident that their growth rate will be more than 25%. And hopefully, similar to core portfolio, this portfolio also will make up for the underperformance in the upcoming few years.
Sure, Samit. So, we are in maybe some kind of a consolidation phase given the macroeconomics and given the, geopolitical risks of us. Have you framed some opinion or view that how deep could this correction go and how you would kind of, add cash levels in a portfolio? And how are you kind of, maybe handling new client portfolios versus the old client portfolios at this juncture?
Right. See, again, it is very difficult to time or even know how much the correction would be. Mostly these are unknown factors because of which corrections happen. Known factors rarely create large corrections, right? So I don't think without given the current circumstances, even if the war is to escalate, I think Indian markets at an index level probably will correct up to 10% or so. And in that correction, I'm sure there will be many stocks which will correct 20, 30, 40%. So as there are some analysis which are showcasing that today the index is outperforming the average stock. That means, until now, until a couple of quarters ago, the median performance was way better than the index performance. Now it's reverse. That means many more companies are underperforming the index, right? And it looks like it is going to be very difficult to generate the same returns that we have generated as easily as what we have been able, because the performance have been able to mask a lot of mistakes. Investors have bet on it. Companies, even if they haven't delivered, if they have got the story right, they have made money. So even if you got like the worst of picks, they have made money. I don't think that's going to be possible. It is probably, you will probably end up losing money in any mistake that you make going forward. And it is going to be extremely, I think, bottoms up stock picking kind of a market, given that we had a broad market for the last 3-4 years. So it doesn't last for too long. Now it has to be back to fundamentals. Only fundamentals and earnings growth will drive the returns, because the P multiples for most companies have contributed to almost 70-80% of the returns, and that cannot sustain. Now going forward, 100% of returns probably will be contributed by earnings, but P multiples may take away some of those returns. So if your returns have been mostly driven by P multiple, and if earnings disappoint, you can go have a huge negative returning period. Right? So going forward, I think we never take top-down cash calls. It's mostly bottoms up. If bottoms up, we find companies which have become expensive, we exit. And if we don't find opportunity, we stay in cash. For new investors, we are taking a bit slow, and we have always never deployed on the first day. It's generally 1/3, 1/3, 1/3. So 1/3 right away, 1/3 after a month, and 1/3 after 2 months. And in the meantime, if there is correction at the stock level, they come in at the buying price, we'll buy it. But we never really just keep on waiting. We have a systematic way of deploying, and we do that depending on sort of our comfort of valuation of the portfolio. That time can stretch up to 6 months. Today we are taking 2 to 3 months to deploy. And if the correction really goes up to 10%, probably will deploy the entire cash amount that we have. Because I have never seen a large crash when the fundamentals of the corporate world or companies are this strong. We could go through a correction which can be 10% or 15%, but I think one has to ride such corrections. You can't really try to time and get out of it. Those are very, very these are very difficult things to do. You can do it right. Once you do it 4 times, maybe you'll get 1 right. But to consistently generate alpha by trying to time is not that easy. So better to focus only on bottoms up, stock picking, only invest in companies where you are comfortable with the growth and its subsequent sort of valuation that it's presenting. And, just follow the portfolio rather than trying to confuse your mind with a lot of these macros, and, try to see your companies, whether they are going to be really going to be fundamentally affected by what's happening, in Israel or in Ukraine. And if it has no relationship, just sit tight, hold on, because, they will deliver. They may go through some knee-jerk reaction in between, but one has to ride through such reactions. Otherwise, you keep on booking profits with the short-term capital gains. You may, just end up paying, and probably later on you'll buy it at higher price than what you got out at. So it's not just one way that you get out, but getting in also is one of the most difficult. A lot of people got getting out right during COVID, but they didn't get the getting in right, and they ended up getting in at much higher price compared to where they got out at. So those kind of things look easier looking back in hindsight, but is extremely difficult to execute, and that too consistently. So something which you can't do consistently, there's no point in just randomly doing thing for one time. So I would say if you have a science and if you have that capability to do it consistently every cycle, do it. If not, then they just take the easier way out of being invested based on your stock comfort.
Sure, Samit, absolutely well said. And I 100% agree with you that yes, the value investing kind of style, which was thriving more on PE rating, that opportunity seems to be now receding. And then growth investing, which was focusing on earnings growth, is something which will kind of rule the subsequent bull run from here onwards. And that is what is kind of bottoms up investing that you primarily have been doing. Moving on to some of the I would say ecosystem in terms of drivers of this market, which is like money coming in either from a DIIs versus FIIs. We have seen that also an important aspect while making investment decision. We have seen FIIs taking money away when interest rates are going up in the West, and now when there is an expectation of interest rates actually coming down, which may get derailed or may get delayed because of the war situation, but FI ultimately sooner or later will have to come to India, because as the beginning you said, India at present is a structural story, and it is a different new story, and hence we have to view it from the lens of maybe high valuations in a longer term, because it's a long-term structural story. So from that point of view, when FIIs invest, they generally invest in high quality businesses, and that is exactly what maybe now were starting to rise. Before this correction happened, we saw Bajaj Finance, for example, rising after a long time, HDFC Bank rising after a long time. Right now, when market will correct and market will go up, how will you handle this particular cyclical shift in your portfolio? Will you see, because it always happens that the leaders of last bull run never lead the next bull run. Maybe some of these stories which were rising in the last bull run may take backseat, and new stories will come up, and those new stories could be HDFC Bank and some of those sectors, maybe IT sector, which have not participated, or again maybe specialty chemical sector. How will you kind of see and view this aspect of the market here onwards?
Right. Yeah. See, at a macro level, I think FIIs have given too much credence to valuation, and hence they are moved towards the cheaper valued countries, and that hasn't really worked out well for them. I mean, their ownership of India is today at the lowest level, 16%, compared to at highs of 22%. That's a big gap, right? So I think they have made a mistake. In the long run, as I have said, investors will migrate towards growth, and it's all about the scarcity of growth which will drive, their movement. So, for example, during the 2011 to 2020 cycle, when overall market growth in India was extremely low, it was in single digits, there were certain segments which were doing really well, and they were consistently doing well, and all investors migrated towards that. Similarly will happen if the entire globe doesn't offer you that kind of a growth which they have historically offered, right? China is barely growing at 3-4%, and that too struggling because real estate is their biggest driver, and which is struggling. Europe is almost no growth. US is 3-4% kind of a growth, and India is the only country where you have 7-8% growth, plus inflation is reasonably high, which is under control. So you have 11-12% kind of a growth. And given the financial stability of India, given the deleveraged nature of Indian corporate, as well as the financials of governments are reasonable. It's way better than average. Right? It's possible that our currency depreciation may be much lesser than what we have had in the past. Today, even the differential in our interest rates, is just 2 or 3%, which used to be generally much higher than that, right? So it's possible that our currency may just depreciate by 2 to 3% compared to like 3.5-4% in the past, right? So this kind of a dollar return that India offers is going to be noticed. If India continues to do that consistently, slowly investors will migrate towards India. It is going to happen because I don't see any other large country which offers this kind of liquidity as well as this kind of a consistent growth, over the next decade. So at a certain point, see these kind of tactical plays where China looks very cheap and people are just moving towards that, it's going to be very seasonal. It's very tactical that they are doing it. I don't think it's a structural China bull market which has started. It's a very short-term kind of a thing. But in the long run, they will gravitate towards growth. Maybe they will realize that they made a mistake by just focusing on the valuation, but India keeps on delivering on growth. And when there is a correction in India, maybe 10%, a lot of investors that we have spoken to have been just waiting for the last 2 years to get into the market, and especially foreign investors. And those are the investors, if they see an opportunity of 10%, 15% kind of a fall, I think they may suddenly come in. And one of the large brokerage houses had estimated that just moving from 16% ownership to average ownership, is at least $100 billion buying for the foreigners. And at the same time, domestic supply, keeps on coming. So again, growth is the bottom line. We would not try to predict which theme is going to play out. Let them show proof that they are playing out, and you don't need to preempt. Once they start playing out, you follow them, because a theme which plays out for many years, not just 1-2 years. And you want to bet on themes which are going to play out at least for 5-6 years. So even if you are able to play 4 years of that and wait for a few quarters to get comfort on that growth, that's fine. You just tweak your portfolio later on. You follow growth, and once you follow growth, automatically your portfolio will sort of replicate the growth kind of industries, and that's the advantage of bottoms up stock picking, rather than top down is more, I think, trying to predict macros, which is very difficult. Bottoms up is something where you can see the proof in the company's quarterly numbers, you can see the proof in the balance sheet, you can see the story, much easier than trying to predict at a country level. And hence, we would just continue to bet on that.
Sure, Samit. So, I also remember you have in the past come up with this, research paper that obviously stock market is cyclical, but within that, mid and small caps have a 4-year pattern, 4-year cycle.
Yes.
So now, maybe, we have seen this time a 5-year cycle where markets, where, stocks have been actually lingering, maybe because of the continued liquidity coming from DIIs, and DIIs have become smarter over time also. It's not that we will this time maybe see panic because, investors have become, smart,
Yeah.
right? So what do you see, is that 4-year pattern, continuing? How do you see this time correction happening, or
Yeah.
how deep will that correction go?
Sure. Yeah. I mean, see, I had presented that, and what I had said was, I look at the peak and the trough, right? So, the previous peak, I looked at multiple cycles. So, 2008 was, say, the peak. 3 years down the line, 2011 was another peak. Then again, 2015, and after 2015, again 2018. And after 2018, again, I think towards the end of 21, we had another sort of peak. And so last peak happened in December of 2021, right? And if I think that it has generally the average cycle has been 3.5 years or so, 3.5 years. And if you assume that kind of a cycle, maybe sometime in 2025, mid of 2025, is where that average, of course, I mean, there's no way to predict it. These are just, like statistics, right? But if you believe in the cycle, then that's where probably this cycle will peak. But even the 2021 peak, the correction after that was very small. Historical corrections has been 35%, 40%, right? But this time the correction was barely 15%. So because of the fundamentals, even though the jump from bottom of 2020 to the end of 2021 was very sharp, even after that kind of a jump, the correction was barely anything. Nifty didn't even correct, I think, double digits. So one has to not just rely on statistics. That will be the end of the cycle. What kind of correction will happen, I think, depends on the fundamentals of companies at that time. So 2018, the fundamentals of companies were not that great. Companies were leveraged. The banking system was just starting that financial crisis. Government was trying to clean up their PSU. So India was at least at an economic point of view at the peak, and things were looking to get worse. Similar was the case in 2008. Similar was the case in 2011. After 2011, there were multiple scams, and India went through a mess of the currency crisis. We need to see that sign. Okay, at an economy level, not just at the valuation level, but also the economy level, we need to be seeing the peaking, and worst time seems to be ahead of us. Right now, doesn't look like valuation wise there is a peak, but if it was matched with excesses in the economy, there was too much over leverage, the credit cycle had stretched, those kind of things. If we had seen that kind of sign, or the operating cash flow falling behind the book profit growth, exact opposite is happening today. Today the operating cash flow growth is higher than the book profit growth. The leverage actually is still deleveraging. 2 quarters back it was 0.2, now it's at 0.14. Median debt to equity. Credit terms are shrinking. If you look at the working capital days, they are shrinking. So these are not the signs of economy picking up. So when valuation and economy peaks at the same time, that creates the biggest crash. So one needs to probably evaluate when that cycle timing comes near that 3.5 years, and see where the fundamentals lie. And if they are strong and there are no signs of breaking up, I think one can't just get out because you see a correction of 15%.
Or Samit, I'll just ask one last question. We have understood over time, and there's a very, I would say, long track record of both of your PMSs, core and, SSP. But you recently also started the large cap PMS, which is large and mid cap biased. If anybody has to invest with 3-year horizon now,
Yeah.
Is it possible that your large cap PMS actually delivers similar return to core or small cap, or how should one actually kind of
Yeah.
I would say evaluate and take a decision? Because there is one of our clients who has asked this question that you have multiple products. It's like large and mid and small and micro.
Right.
From investor point of view, how should one kind of see these three different portfolios, and
Sure.
what should one expect from these three portfolios?
Sure. See, the core portfolio, which is the mid and small cap portfolio, and the small cap portfolio is something that I manage. I did not have ability to manage large cap portfolio. Neither do I have the bandwidth, nor did I have the skill sets, because my expertise has been finding emerging high growth companies, right? But fortunately, we had two team members, Satish and Kshitij, where we had given them prop money to sort of try a portfolio out, large cap, because we were missing anything in the large cap space, which is the largest, from a business perspective, that that made sense. And I said, and they have always been following large cap stocks, so I said, try it out. So we went through multiple back and forth during that trial phase. So with prop money, they started managing the portfolio. In 2 years, I got enough confidence that we can offer it to the clients, and that's where last August we selectively started offering to the clients, where we knew that these clients are longer term and they were with us for a long period of time. So we offered them, and in the last 1 year, I was surprised that they continued their outperformance, and they delivered almost 55% kind of a return in the last 1 year, compared to probably 30-35% for the BSE 500. See, my thumb rule for long-term returns are earnings growth, right? So large cap portfolio, because they are mostly investing in the top 150 companies, I don't think that universe can grow at more than 20%. It's not possible, So we are targeting, around 16 to 18% kind of a earnings growth for this portfolio. Long run returns have to be in that kind of a range. For the core portfolio, we are targeting maybe around 20 to 25% kind of growth. So midpoint will be 20 to 23%. So net of fees will be about 20%. That is what we have been targeting. Historically, we have found companies which have grown at much higher rate than that. Small cap, our expectation of growth is close to 25%. Because smaller companies tend to grow much faster, and hence the return expected is in that range. Again, we have found growth which is much higher than that. But the expectation is in that range. 16 to 18% for the large cap, around 20 to 23% for the core portfolio, and 25-27% for the small cap portfolio.
So given this logic, ideally, small cap portfolio, because it has underperformed in the past, becomes the most attractive, I would say, investment at current times.
Right. That's what I think. But again, not everyone has the appetite to ride through a small cap performance.
And then maybe your AIF becomes a better bet, because it's a mix of both core and small cap.
Exactly.
And how do you decide that, if I may understand, how much from core and how much to small cap? Is it at a stock level, or it's just a blend of both PMSs?
So it includes all the stocks from the core portfolio and the small cap portfolio. Generally, it's in the proportionate. So for example, if it's in the core portfolio, typically will have double the allocation of a small cap portfolio. So if SCP has a 4% allocation in in the PMS, then there we will have, say, 2%. But if SSP has 4% allocation, then if that gets added in the AIF, it will be about 1.25%. So we want to maintain that 35 to 40% in the small cap, and the remainder in the mid cap side. So basically, SCP should represent about 60 to 65%, and small cap should represent 35 to 40%. But the advantage of AIF is also that we also are able to do pref allotment. So sometimes, so we did companies like MacFos, we did, EFC, TTC, we did good luck. Those kind of pref allotments are is something which PMS structure cannot do. You can only do that in AIF. So that's the added advantage. So in addition to the SCP and SSP portfolio stocks, we also have 3 or 4 of these pref allotment if we get it at a significant discount, compared to the market price.
Sure, Samit. I think this has been really insightful, and almost all the thoughts and ideas have been discussed. And whatever questions you have, I wanted to ask, it's done. Thank you everyone for logging in, and thank you, Samit, for your time.
Sure.
Happy weekend to everyone. Thank you.
Thank you so much.